Fiat currency. Fiat money is a government issued currency that is not blocked by a physical commodity such as gold or silver, but rather by the government that issued it. The value of fiat money is derived from the relationship between supply and demand and the stability of the issuing government, rather than the worth of a commodity backing it. Most modern paper currencies are fiat currencies, including the US dollar, the euro, and major global currencies. The key takeaway: fiat money is a government issued currency that is not backed by a commodity such as gold. Fiat money gives central banks greater control over the economy because they can control how much money is printed. Most modern paper currencies, such as the US dollar or fiat currencies, one danger of the fiat money is the government can print too much of it, resulting in the economy. The term fiat is a Latin word that is often translated "it shall be" or "let is the be done." Thus, fiat currency only have value because of the government maintains that value. There is no utility of fiat money in itself. Fiat currency came about the government would mint coin out of a valuable physical commodity such as gold or silver or print paper money that could be redeemed for a set amount of the physical commodity. Fiat, however, is incountable and can't be redeemed simply because there is no underlying commodity backing it. Because fiat money is not linked to physical reserves, such as a national stock pipeline of the gold or silver, it risks losing value due to inflation or even becoming worthless in the event of the hyperinflation. In some of the worst cases of the hyperinflation, such as in Hungary immediately after World War II, the rate of inflation can be double in a single day. Furthermore, if people lose faith in a nation currency, the money will no longer hold value. This is much different from a currency backed by gold. For example, it has inherential value because of the demand of the gold in jewelry and decoration, as well as the manufacturing of electronic devices, computers, and vehicles. The US dollar is considered to be both fiat money and legal tender except for private and public debts. Legal tenders is basically any currency that has a government declared to be legal. Many governments issue a fiat currency, then make it legal tender by setting it as the standard for debts repayments. Earlier in US history, the country's currency was backed by gold and in some cases silver. The federal government stopped allowing citizens to exchange currencies for government gold with the passage of Emergency Banking Act of 1933. The gold standard, which backed US currency with federal gold, ended completely in 1971. when the US also stopped issuing gold to foreign governments in exchange of US currency. Since that time, US dollars are known to be backed by the full faith and credit of the US government. Legal tender for all debts, public and private, but not redeemable in lawful money at the United States Treasury or at any Federal Reserve Bank. As printing on US dollar bills used to claim. In this sense, US dollar are not legal tender rather than lawful money, which can be exchanged for gold, silver, or any other commodity. Fiat money serves as good currency if it can be handled the role that can nation economy needed for mandatory unit storing value, providing a numerical account, and facilitating exchange. It also has excellent scenario, meaning it is most cost efficient to produce that a currency directly tied to commodity. Fiat currency gained promises in the 20th century. Fiat currency serves as a good currency if it can be handled the role that a nation economy needs of its monetary unit, storing value, providing a numerical account, and facilitating exchange. It also has excellent, meaning it is more cost efficient to produce than a currency directly tied to a commodity. Fiat currency gained prominence in the 20th century in part because the government and central bank suggest to insulate their economy from a vast efficient of the natural booms and bust business cycle. Since fiat money is not a scarce or fixed resource like gold, central banks have much greater control over its supply, which gave them the power to manage economic variables such as credit supply, liquidity, interest rate, and money vacancy. For instance, the US Federal Reserve has the dual mandate to keep unemployment and inflation low. The mortgage crisis of the 27 and subsequent financial meltdown, however, tempered by the belief that central bank could necessarily prevent depression of the serious recession by regulating the money supply. A currency tied to gold, for example, is generally more stable than fiat money because of limited supply of the gold. There are more opportunities for the certain of the bubble with the fiat money due to ultimated supply. The African nation and Zimbabwe provided an example of worst case scenario in the early 20th century. In response the serious economic problem, the country's central bank began to print money at the stretching pace, resulting in hyperinflation hyperinflation. Experts suggest the currency lost 99.9% of its value during this time. Prices rose rapidly and consumers were forced to carry bags of money just of the purchase basic stamp at the highest of the crisis. Zimbabwe government was forced to issue 100 trillion Zimbabwe dollar note. Eventually, foreign currencies were used more widely than the Zimbabwe dollar.